if the GDX, the gold miners, are saying they're at resistance and going to pull back, does it make sense that gold would go higher? Or would it be more likely that gold would pull back, which would then cause miners to pull back? And the answer is yeah. I mean, it would make sense that gold would pull back. And look at the miners today, all the way down at 56.50, already pulling back. Now, on a base case here, we have support around $53 on the GDX. So if we come down another $3.60, we'll then tag support. All right.
Gold has been on an unstoppable rally, buoyed by strong safe haven demand amid rising trade tariffs and escalating geopolitical tensions. The bullion reached a record high 4 times in the last 5 days, breaching the 3,050 level. The Fed's signal of potential rate cuts this year added further shine to the yellow metal, pushing gold ETFs higher. Gold Miners ETF GDX, which offers exposure to gold mining stocks, has climbed 32.3% since the start of the year. From a technical perspective, the fund has reached a 52-week high and is trending upward. If GDX gold miners reach resistance and pull back, gold is likely to follow suit, further pressuring the miners. Gareth Soloway, a famous technical trader, explains that the most critical factor driving the gold rally is the ongoing trade tariff disputes, which will drive inflation higher and threaten domestic economic growth. Additionally, the inflationary pressure caused by new tariffs will benefit the precious metal's status as a hedge against rising prices. Geopolitical tension also escalated this week as Russia-Ukraine ceasefire talks stalled and Israel intensified airstrikes, boosting safe haven demand. Additionally, hopes for a rate cut drove gold higher. The Fed, in its latest meeting, hinted at possible interest rate cuts by year-end. Lower interest rates will continue to support gold prices as they raise the yellow metal's attractiveness compared to fixed income assets, such as bonds. Notably, gold is susceptible to rising U.S. interest rates, as these increase the opportunity costs of holding non-yielding bullion. Moreover, on the monthly chart, silver will be trading within July's range until it breaks above $39.53 or below $35.80. That is a relatively wide range that could encompass trading for this month or even longer. This is something to be aware of, as the monthly chart for July shows a potential bearish shooting star candlestick pattern. Since it is on the monthly chart, a sustained decline below that level could lead to a drop that eventually reaches the lower trendline of an ascending channel. The shooting star indicates selling pressure on the larger time frame and represents potential resistance for silver if it continues to rise. The excerpts from Gareth's interview are now available. Please click the bell symbol to receive timely updates and subscribe to our channel before we continue our conversation. Thank you and have fun watching the video.
If the GDX, the gold miners, are saying they're at resistance and going to pull back, does it make sense that gold would go higher? Or would it be more likely that gold would pull back, which would then cause miners to pull back? And the answer is yeah. I mean, it would make sense that gold would pull back. And look at the miners today, all the way down at 56.50. Already pulling back. Now, on a base case here, we have support around $53 on the GDX. So if we come down another $3.60, we'll then tag support. All right, Bitcoin. Wow, Bitcoin over the weekend surging up. Again, I'm always a little suspect on weekend moves because the volume is a little bit thinner. But look at this big move. So we knew we had resistance here. It came up, it rejected it, and then it pushed through. And then look at this. Overnight on Sunday, we pushed up, and then look, they've already reversed it. And the one thing that you have to remember is that the bear candle, meaning the topping tail right here, that remains the level. And I went over this quite a bit on the weekly wrap-up on Friday afternoon, the game plans last week. And what I said to you guys was, listen, you can believe whatever you want to believe, but the charts are in charge. Okay, which means that until you negate the topping tail, which is here, all right, and the way you negate the topping tail, you need a daily close above the topping tail high, then technically you must be suspect about whether or not this is the next bull run, or is it just a retrace when the stock market is at all-time highs with buyers coming in. Now, listen, we'll see where this ends, but pretty nasty little reversal here early in the day. But again, if we get a daily close above 123,200 or so. Okay, now game on. Like I said last week, you can go to 130, maybe 135, maybe 140. But as long as you do not have a daily close above this, you must be suspect about it. And that's just probabilities, guys. It's nothing to do with personal feelings, nothing like that. It doesn't really matter, frankly. It doesn't matter what I think, what you think, what anyone thinks, frankly. It is all about the probabilities. And the faster we all learn that, the better we all trade, right? I mean, that's really what it comes down to.
Gold's rally is also buoyed by central bank buying and a weaker dollar. Notably, the dollar index has slipped to a 5-month low. Meanwhile, China extended its purchases for a 4th consecutive month in February. According to the latest report from the World Gold Council, global gold demand reached a record high in 2024, driven by sustained central bank buying and growth in investment demand. Central banks accumulated more than 1,000 tons of gold for the 3rd consecutive year. Global investment demand increased 25% year over year. Gold's recent resilience has been driven by surging central bank demand, particularly from BRICS nations and emerging economies that are actively diversifying away from the US dollar. This global de-dollarization trend has resulted in record levels of sovereign gold purchases. Moreover, the President Trump-led tariff tensions boosted demand for gold and related mining stocks and ETFs. The US dollar slightly recovered on Monday, consolidating recent moves after a trio of market-moving events on Friday that showcased the fragility of the greenback: a dismal U.S. jobs report, the resignation of a Federal Reserve governor, and President Donald Trump's firing of a top statistics official. Against a basket of currencies, the dollar edged up 0.1% to 98.77 after sliding more than 1.3% on Friday.
The US dollar today is up fractionally. Not much of a move here, guys. Again, just up slightly. I wouldn't say there's really anything new to divulge on this. Beautiful parallel channel that the dollar is still stuck in. And again, we're not at the highs, in which case it would be a sell, and we're not at the lows, in which case it would be a buy. Ultimately, we are still in a downtrend. The 10-year yield down slightly. This would be another example of a kind of a little bit of a stretch on a bearish pattern, but the fact that it's coming after breaking down through this wedge pattern low and ultimately confirming the breakdown here on this candle, this again would be overall slightly favoring the downside. In fact, decently favoring the downside. So you have a wide range reversal or breakdown candle, and then inside bar action here. That's inside of this move, which is basically digestion of that breakdown. We're below this trend line and we've confirmed below. So that would again give us a negative bias on the 10-year yield for eventual break to the downside. Now we are down today, but we don't know yet if it's going to be the beginning of the bigger move or if it's going to just chop a little bit more. We talked about NVIDIA here, NVIDIA down on the day. The only thing on NVIDIA that I care about, though, is this trend line. This trend line in technical analysis, this would be essentially your break point. And my gut is telling me that when this breaks, that's when the markets start to break. And listen, maybe NVIDIA continues to hold this line for the next week, 2 weeks, 3 weeks. We don't know. But one thing I do know is that NVIDIA has led the market up, and it hasn't broken this trend line, even though the S&P has broken this upsloping trend line, right? We've looked at that before from the very lows of September 7th. And ultimately, if this breaks, that would be your break point for where you would expect, okay, this led the markets up. Likely the markets would be led down by NVIDIA. AMD is a little bit different here, guys. As we take a look, you have this nice little uptrend as well. This stock, again, has gotten a little bit ahead of its skis, but it has slowly started to correct. One thing here, though, this trend line would remain support. So you can see from your April 7th low through the low here on the 21st of April, all the way to your low here on June 13th, it could actually pull back to this level, and this would still be major support. And so that's something else. There's one other trend line, though. You can see right here. There's this trend line as well. This would be a secondary trend line. So essentially, if AMD breaks 166, you would expect to fall to about 150. But at that point, it would get a bounce, or you'd anticipate a bounce. And so there might even be a trade there, right? Technically speaking, if it breaks 166, you could short it and then cover your short and go long at 150 for a technical bounce there. All right, big move here, guys. Take a look at the drop on C3AI. This is remarkable because this is an AI play. And they basically pre-announced their earnings today, guys. They pre-announced, they're not supposed to report until early September, but they pre-announced and their numbers are not good. Their estimate for revenue was about 104 million. They're telling Wall Street they're only going to come in around 70 million in revenue. That's a 33% lower amount of revenue than was expected. All right, that is not good. And that's why the stock is down like 34, 35% today on the day. In addition, year over year, a 19% growth drop, meaning that they actually slowed. They're making less by 19% than they did last year.
Let's dive into the interview. Geopolitical concerns, central bank purchases, safe haven demand, and forecasts of Fed rate cuts are all contributing factors to gold's recent climb. Although technical indicators suggest that GDX miners are approaching resistance and are poised to pull back, which may put short-term pressure on gold, the overall macro environment remains favorable for precious metals. On the monthly chart, silver, however, is confronted by significant range limits and possible bearish signals. Despite powerful macro forces, might the decline in GDX lead to a wider gold correction? If geopolitical tensions subside, will central bank purchases be sufficient to maintain gold's momentum? Share your thoughts in the comment section below. If you find this video informative, please consider supporting us and turning on notifications to stay updated about our latest videos. See you in the following video. Thanks for watching.